In March 2026, OpenAI raised $120 at an $852 billion valuation. That same month, its core product lost daily active users in absolute terms for the first time. Both facts are real. They cannot coexist in a healthy business. ChatGPT's US mobile daily active user share fell to 38.7% in March 2026. 6 months earlier, it held nearly 52%. That is not a dip. That is 4 consecutive months of decline, confirmed by Uptopia, and it is accelerating. The web traffic story is worse. ChatGPT commanded 87% of generative AI web traffic in early 2025. By March 2026, that number had fallen to 56.7%. 30 percentage points gone in 12 months, while the valuation climbed to nearly $1 trillion. The contradiction is not an accident. It is the story. If you think this is about one company losing users to competitors, you are looking at the wrong thing. The real exposure is in the capital structure underneath ChatGPT, a stack of circular commitments, borrowed confidence, and contingent money that reaches from Silicon Valley into the retirement accounts of people who have never heard of Stargate. Start with the product economics. ChatGPT has 900 million weekly active users. That number is real. What it implies about revenue is not. 81% of those users pay nothing. The free-to-paid conversion rate sits between 5 and 6%. The compute required to serve those 900 million users costs money regardless of whether they subscribe. In 2025, OpenAI spent $69 for every dollar it earned. Total revenue, $13.1 billion. Total expenses, approximately $22 billion. The gap was not a rounding error, it was the business model. The inference costs, the direct cost of running the model every time a user sends a message, hit $8.4 billion in 2025 and are projected to rise $14.1 billion in 2026. Compute already represents approximately 40% of revenue. The faster ChatGPT scales, the more it costs to operate. Scale is not the solution. Scale is compounding the problem. If you find this valuable, subscribe. Every notification delivered is one fewer person caught off guard. OpenAI's projected 2026 net loss is $14 billion. That is roughly 3 times the 2025 loss estimate. Cumulative losses through 2028 are projected at $44 billion. Through 2029, the projected total cash burn reaches $115 billion before any profitability. The Manhattan Project cost roughly $30 billion in today's dollars. OpenAI expects to burn 4 times that amount before it turns on profit. The $122 billion round looks like a solution. It is not straightforwardly one. Amazon anchored the deal with a $50 billion commitment. $35 billion of that $50 billion is contingent. It releases only if OpenAI completes IPO by the end of 2028 or achieves artificial general intelligence. SoftBank contributed $30 billion, backed by a $40 billion bridge loan it secured days before the round closed. The capital is real but conditional, and portions of it are borrowed before it even arrives. The money that does arrive does not leave the circle. OpenAI committed to purchase $250 billion during cloud services from Microsoft, its largest legacy investor. NVIDIA invested up to $100 billion in OpenAI and will supply the chips that fill its data centers. OpenAI's CFO Sarah Friar acknowledged directly that NVIDIA's investment money would effectively return to NVIDIA. Amazon committed $50 billion as an equity investor, while simultaneously signing OpenAI as a cloud compute customer. Bloomberg documented this structure in detail in March 2026 and called it what it is: circular. The investment and the revenue are frequently the same transaction, routed in a loop. One company's capital commitment becomes another company's reported demand. The market treats the demand as real. The valuation reflects the demand. The next funding round is justified by the valuation. The product was the public face. The balance sheet was the architecture. The companies at the edges of that circle are now exposed to its structural logic. Oracle is Stargate's primary construction partner, breaking ground on data center sites across Texas, Michigan, Wisconsin, Wyoming, and Pennsylvania. Nearly 7 gigawatts of planned capacity, over $400 billion in committed investment across 3 years. Oracle carries approximately $100 billion in debt to fund this. Barclays downgraded Oracle's stock to underweight in early 2026 and warned that its credit rating could approach junk status if Stargate spending continues to outpace revenue conversion from OpenAI. In March 2026, Oracle's social media team posted that the company was highly confident in OpenAI's ability to raise funds and meet its commitments. The market's reaction was immediate. The stock fell 2.79% within the hour. Venture capitalists publicly compared the language to what you hear at a bank run. The message intended to project stability revealed the dependency underneath it. Oracle's credit standing depends on OpenAI's fundraising ability. OpenAI's fundraising ability depends on its revenue trajectory. Its revenue trajectory depends on ChatGPT's conversion rate. The conversion rate is falling. Microsoft disclosed in January 2026 that 45% of its $625 billion cloud backlog is tied to OpenAI. The disclosure was part of a routine filing. The market did not treat it as routine. Microsoft's stock fell 12% in a single session, erasing $440 billion in market capitalization. Microsoft's cloud growth narrative, the story that supports its position as one of the 2 or 3 most valuable companies in the world, runs through a company projecting $14 billion in losses this year. That is not a product problem. That is a valuation problem at scale. Most people who hold stocks do not own OpenAI. It is private. They own what is in their index funds. Microsoft is the second largest holding in the S&P 500. NVIDIA is among the top 5. Oracle is an index component. Every broad market retirement account, every default 401(n)(a) allocation, every passive investment vehicle tracking the S&P 500 holds these companies at elevated weights. The Shiller cyclically adjusted price-to-earnings ratio for the S&P 500 currently sits at approximately 38 to 40. In 155 years of recorded data, that ratio has been higher exactly once. March 2000, when it reached 44.19, 1 month before the Nasdaq began a decline that eventually erased 78% of its value. The S&P 500 fell 49% in the years that followed. The ordinary investor did not buy into OpenAI, they bought the index. The index bought the chain. Subscribe now. The people who understand this before it moves are not the ones caught watching it afterward. On March 27, 2000, Cisco Systems briefly became the most valuable company in the world. It surpassed Microsoft. It was the indispensable infrastructure layer of the internet build-out, the company that made the connections that made everything else possible. 3 weeks later, the Nasdaq peaked. What followed erased over 75% of Cisco's market value. The stock did not recover to that level for 25 years. It took until December 2025. Cisco's networking equipment was real and essential. The assumption that the infrastructure demand was permanent was not. The companies buying Cisco's gear were borrowing the capacity for customers who had not arrived yet. When the customers did not arrive on schedule, the financing chain collapsed inward. NVIDIA's current market cap is $4.5 trillion, roughly 14 times Cisco's current value. It holds the same structural position in the AI cycle that Cisco held in the internet cycle. The indispensable hardware layer, the company without which none of the infrastructure gets built. Hyperscalers are projected to spend $660 to $690 billion on AI infrastructure in 2026 alone. That spending flows heavily through NVIDIA. Analysts project $1.5 trillion in cumulative data center and AI infrastructure debt by 2028. The question Cisco answered in 2000 applies here. What happens when the demand assumptions prove optimistic? The workers building Stargate across 5 states are employed by a construction cycle funded by commitments from a company projecting $14 billion in losses this year. OpenAI projects 25,000 on-site jobs. That employment is downstream of a financing structure where $35 billion from the anchor investor does not release without either an IPO or the achievement of artificial general intelligence by 2028. The final piece is the one that reframes everything. ChatGPT's market share collapse is happening in the segment that matters least. It is the consumer and free tier market. The enterprise segment, where the revenue per user is highest and the margins are real, is moving somewhere else. Menlo Ventures reported in December 2025 that Anthropic now captures an estimated 40% of enterprise LLM spending. OpenAI was 70%. Soster reported that Claude wins approximately 70% of direct enterprise deals against OpenAI in head-to-head comparisons. In March 2026 alone, Claude's US mobile daily active users tripled in a single month. Power users spent an average of 139 minutes per day in the app. Churn fell to 12%. $852 billion price is a dominant winner. The enterprise market, the segment that generates the revenue that would eventually justify the valuation, is actively choosing something else. The infrastructure is real. The data centers are going up in Texas and Michigan and Wyoming are physical structures consuming real electricity. The chips are real. The language model technology is genuinely useful. Companies are deploying it. Productivity gains exist. None of that is the fantasy. The fantasy is the monopoly. The assumption that the first product to reach scale would hold it permanently. The way social media locked in network effects that compounded for a decade. Language models do not lock in users the same way. Distribution does. Whoever is already in the device, already embedded in the enterprise workflow, already integrated into the search engine and the operating system and the cloud contract. That is where the durable revenue goes. ChatGPT invented the category. It does not automatically own the category. Cisco built the internet's backbone. The internet survived. Cisco spent 25 years recovering. WorldCom built the fiber that carries traffic today. The fiber still works. WorldCom does not exist. The infrastructure outlasts the financing structure that built it. The money circling through OpenAI's capital stack will eventually stop circling. The conditional commitments will come due or fall away. The debt Oracle is carrying will get rated by someone who does not have a Stargate contract to protect. The S&P 500 concentration will meet whatever the earnings justify after the capex cycle clarifies. What remains after that is not nothing. The technology works. The demand for it is real, if smaller than the financing assumed. The companies that built AI tools people actually pay for, on sustainable unit economics, in the segment where enterprises sign multi-year contracts. Those companies inherit whatever real demand existed underneath the fantasy. The money was real, the monopoly was not. And the technology was never the problem, only the story told about who would own it forever.